Good morning, everyone. My name is Nathan Bird, founder of the Acquisition Headquarters, headquartered here in Salt Lake City, and we're excited for today's live stream and also an educational distribution of content for you, the small business and mid-sized business owner out there that's running your companies anywhere between 2 million to 50 million in EBITDA, as well as investors. Just the other day, I had a friend, he called me and said, "Hey, listen, I have 1 million in liquid, and it's gonna cost me a significant amount of my taxes." And I was like, well, I may have somebody to help you with that specific scenario, and that would be Taylor Proactive Team and Merrill Taylor. Before we hop into Merrill's educational portion, I wanted to share with you guys a little bit about the acquisition headquarters, what we're doing at AHQ, how it benefits you, and how you can be involved. So our goal today, again, is to establish purpose and value for the Acquisition HQ, learn tax strategy from Merrill Taylor with the Taylor Proactive Team, and who we are. The primary reason we exist is to help our business owners, investors, and service providers that are wanting to build relationships through M&A, through online and in-person education and experiences. The problem that we saw was the lack of education during transactions, and we decided as an organization to solve that problem through a collective alliance with subject matter experts, as well as creating in-person relationships through event experiences. In addition to that, we also saw a lack of access to those resources that many times investment bankers only had, or other individuals, to help people through the M&A transaction. And also, our main focus is to build lasting teams and trust to be able to execute efficiently and effectively on deals. Our current traction as an organization, we are thrilled that we've currently come from nothing to here today. And September 3rd was the successful launch of our national conference in Salt Lake City. We now have a total of 90 private members on the Acquisition HQ network. We then have completed our fall tour of the Acquisition Headquarters Fall Tour, 5 cities, and on November 17th in Salt Lake City. We've successfully now launched Acquisition Conference in 2026, coming soon to Salt Lake City on March 5th and 6th. We will be launching our 2 city councils, which are going to be a 4-hour template monthly meeting in both Salt Lake City and San Diego, which is called the AHQ Councils in January, on the 23rd January Salt Lake and 30th in San Diego. We also have, again, this is our recap for 26. Hosted 22 events, 15 different cities, 2 national conferences, and a whole lot of fun. So we're excited to be able to continue that momentum into 2026 and 10x our efforts. Here's just a few of the fall tour locations we went to: Denver, San Diego, Salt Lake City. These are just some of our photos, just to give you guys an understanding of the type of events, the type of people, the amazing locations that we typically choose as a company. And moving into, oh, this is a real fun time here in Salt Lake City at an art gallery where we had amazing food, great conversations with others. Where are we going? It's always the question. We've got to have a vision for the future, and we believe that we have a large vision. I did also say we just launched the national conference. We do have our early bird tickets available now, and those can be purchased at aquacon.live to be in the room with all of our council members as well as individuals across the United States. The AHQ Council is beginning in January, releasing San Diego as well as our Salt Lake Council. Nashville and Austin will follow. Today, we are excited to be able to welcome Merrill Taylor with the Taylor Proactive Team. Merrill Taylor has been a tax strategist for over 20 years of experience helping high income earners keep and compound more of what they make. As a founder at Taylor Proactive Team, he leads a strategy first, education driven approach that goes far beyond just your annual earnings. Merrill advises executives, business owners, and real estate investors on advanced tax planning, which is always within the letter and spirit of the law. His clients often face six and seven figure tax bills. Merrill helps turn those tax liabilities into long term financial advantages. We want to welcome Merrill Taylor to the stage today or to this Zoom. Thank you, Merrill, for joining us, and we will allow for you also to share your screen at this moment.
I was on mute there. Yeah. Thanks, Nathan. Appreciate that. Yeah, we're excited to be here and excited to have this opportunity to share a little bit about taxes and how those can be mitigated and managed during all cycles of acquisition, operation, and exit from a business. So I'll share my screen here and we can dive in to that. All right, excellent. So as Nathan mentioned, my name is Merrill Taylor. I'm a CPA. I've been practicing for a little over 20 years now, and got my start with one of the big four, with Ernst& Young, now called EY, and then from there worked for a very large firm in Utah and Salt Lake City, and then uh, about 10 years into my career, I started my own firm and have been running that for the past about 11 years now. Uh, all right, so we want to talk about tax planning and strategies that we can look at in all aspects of a business and its ownership. All right. So we'll start off with talking, kind of setting the stage about goals, key principles. We'll then move into the acquisition phase and what that looks like for taxes, the operation phase, the exit phase, and then finally finish with some Q&A and next steps. All right, so first off, principles and the life cycle overview. So our goals in starting, operating, and exiting a business is to maximize cash. We don't want a lot of money in cash going to the IRS. We like to keep that in the pockets of business owners where it can, we feel, do the most good. So in doing this, we look at strategic alignment. There are a lot of different tax strategies and a lot of things that are out there. So we want to ensure that tax strategies support broader business goals. We want to make sure that they're compliant with tax laws. We don't want any audits that result in an adverse position or any issues for clients. A lot of times that's done through maintaining documentation, keeping records, the defend position. So here we'll jump right in. We'll start with the acquisition phase, then we'll move on to the operation phase, and then to the exit phase and kind of issues that we see surrounding those. All right, so first with the acquisition. So when we're looking at buying a business or starting up a business, we want to find our positioning for the long term and then looking for after-tax success there. So what are some issues that we run into in the acquisition phase? Well, first off, we've got purchase price allocation. If you are buying a business, the purchase price allocation is extremely important to that buyer. And it's on the seller side, it's also important. And we'll discuss some of the concepts and issues on both. And you'll find that there's kind of an adverse position between buyer and seller. The buyer wants one side of an allocation, the seller wants the other. First off, we kind of look at is it an asset versus a stock? When you go in and you buy an operating company, you have the option to either buy the assets of that company and put those assets into your own entity, or you could buy the stock of that entity and end up owning that entity going forward. There are pros and cons to each of them. Usually, buyers want an asset deal. They want to go in and buy the assets of the company because they'll get a step up in basis that they can then potentially use some bonus depreciation on. Whereas sellers oftentimes want to sell the stock because they'll get capital gain treatment for that. So that's kind of our first position where there could be like a bit of a difference between what the buyer and the seller want to do. But most oftentimes we see an asset deal. When you buy the stock of a company, you're basically inheriting all of the potential past issues of that company. So if there was like an outstanding tax obligation or legal obligation or something that comes up, you could be inheriting those with a stock deal. So a lot of times people will want to buy the assets, and that's oftentimes what we see. Now, when you buy the assets, there's what's called the purchase price allocation, and this purchase price allocation, all the assets get divided into classes, and these classes 1 through 7. And usually a buyer wants more of the asset purchase being allocated to the fixed assets of that area. I think of a client that we had that sold recently. They were a franchise owner, but they owned a fitness franchise. And so inside of this fitness franchise, they had a lot of equipment. They had treadmills, they had water rowers, and weights and other workout equipment. So it was very heavy in equipment. And so the buyer coming in wanted more of that purchase price allocated to the equipment because they could get a bonus depreciation. Basically, if you allocated, say, let's say the purchase price was $500,000. If they allocated, say, 250,000 of that to equipment, the buyer could use bonus depreciation and get an immediate write-off of $250,000 in that year of purchase, even if they use debt to buy that. It doesn't matter if they didn't necessarily have to use uh, cash to get that $250,000 write-off. So a buyer wants everything allocated or mostly allocated to intangibles. Now, or excuse me, to fixed assets. Now, anything allocated to intangibles for a buyer is a rough position to be in. So anything that goes to goodwill or a non-compete or a customer list, in the tax code, they're considered Section 197 intangibles, and they have to be amortized over a 15-year period. There's no bonus depreciation available for those. So in my example, if you buy, say, a business for $500,000, 250,000 is allocated to the fixed assets, and say $250,000 is allocated to goodwill, you now have to depreciate that $250,000 over a 15-year period, and it's going to take you 15 years to recoup that $250,000 purchase price. So that's why a buyer really doesn't want things allocated to intangibles. Now, the seller, will get into that when we get to the sell side, but just to kind of cue that up, the seller wants as much allocated to intangibles as possible because the seller, especially on goodwill, will get long-term capital gain treatment, which gives them preferential rates. So there's often this kind of, I wouldn't say animosity, but kind of this, adverse relationship between buyer and seller, and that they're both competing for two different things. Now, there is kind of an issue that runs into certain things, like a non-compete specifically. It's usually we see very little allocated to a non-compete because it's a bad situation for both buyer and seller. A non-compete is a 197 intangible, so the buyer has to depreciate that or amortize that over a 15-year period. But the seller, that is not capital gain income to them. That is ordinary income to them, taxed at the highest rates. So both buyer and seller lose out with anything allocated to a non-compete. So generally, we see very little allocated to non-compete, if any, because goodwill is a better allocation there. The seller gets long-term capital gain treatment, and the buyer still has to do it over 15 years, but at least the seller gets a better tax benefit, and it really doesn't impact the buyer at all that way. All right, so some things to watch out for. Recapture risk. So the seller is going to have recap. Anything that's allocated to fixed assets is going to be given a depreciation recapture to the seller when they sell that. And so if everything gets allocated to equipment and the seller realizes that it's all considered ordinary income because it's depreciation recapture, they may walk away from that deal because the tax side of it is just so onerous for them in that. So sometimes you got to, again, kind of negotiate between how much to allocate to those assets. And a lot of times getting like a third party appraisal of those fixed assets is helpful. Years and years ago, we worked with a restaurant franchise, and they had private equity come in and buy about 60% of their business. And then they went and hired a restaurant equipment company to come in and value all their assets. And so I got to, being a staff person at that time, I was able to go with this person and go to all these locations and walk through and have them do that. So that could be an option, is just have a third party value the assets there. Another thing to watch out for on bonus depreciation, we're talking when you buy all the assets, not all states conform with the bonus depreciation. So you might get a great federal benefit, but the state might take several years depending on how they treat bonus depreciation. And then just to keep buyer and seller honest, there is a Form 8594 that is filed with both the buyer's tax return as well as the seller's tax return, just so that the IRS sees that both buyer and seller are treating that transaction the same way. So it can't be like that the buyer says, "Hey, I bought all fixed assets," and the seller says, "Hey, I sold all goodwill." No, the IRS keeps people honest with this Form 8594 that gets filed with both tax returns. Uh, and then another issue that comes in with purchasing a business, or even just starting up a business, is what is called startup costs. And so startup costs are basically costs that you incur before you actually open and start operating a business. And this happens a lot. Let's take, say, like a retail location. Let's say you're going to start and open up a retail location. Well, you're going to have to buy inventory and put in a lot of costs. You're going to need to build out your space and do a lot of things there. You'll have to hire people. You're going to have to rent the space. You've got utilities that probably start to be incurred. So you've got a lot of costs and expenses that get incurred there. And the tax code treats those startup before you open your doors for business. Any costs that you have are considered startup costs, and you can deduct up to 5,000 of those startup costs. But once you go over 5,000, you then have to depreciate those costs over a 15-year period as well. And there's a lot of kind of thing. Some things do apply for startup costs, some things don't. So that can get a little more technical. So you'd want to work with a tax professional or somebody just to help analyze what costs are startup costs, which costs are not startup costs, and keep an eye on that. All right, so moving on from the startup phase, we'll get into the operation side of things. So as you're operating the business and it's growing and generating more and more income, you'll start to see that your taxes start to go higher and higher as that income goes up. So that's when we start to really look at strategies and ways that we can help save money on taxes through the operations of it. So bonus depreciation is a important part of that. We talked about that a little bit in the acquisition, the startup phase. It also applies while you're operating the business as well. So bonus depreciation is great for the current time, where the tax act that was passed in July of 2025, often called the One Big Beautiful Bill, it extended 100% bonus depreciation. So that means any assets that you go and buy during the year, fixed assets that you need to operate your business, can be written off 100%, regardless of whether you pay cash for those or you finance those. So we've worked with, construction clients are a good example of this. We've worked with construction clients for a number of years, and they will often need heavy equipment and things like that to do their jobs, take care of their customers. And so at the end of the year, they'll be looking to say, okay, what kind of equipment are we going to need in the coming year or even the coming months? And they'll go out and they can buy that in December, get a write-off for that. They don't have to come cash out of pocket. They can finance that 100%. So basically, they could go buy $100,000 piece of equipment and get a deduction for $100,000. And if they finance the whole thing, they don't have to come out of pocket for that. Now, obviously, they're going to have to pay that debt off at some point, but in a growing and building company, there's usually more and more equipment that needs to be bought. And so that's one way that we see bonus depreciation coming and helping people. You often hear about people buying vehicles for business use, and you hear about the rules that if they're over 6,000 pounds, that they can write those off fully in the year of purchase. So yeah, that certainly applies. It's not like, I would say, like a tax strategy that you want to rely on all the time, because then you don't really need to go and buy a new vehicle every year, but usually you just get that benefit in the year of purchase, and then the next year you've got to find something else. So we often look at other tax strategies that are helpful in that. And then if you are a real estate professional, own real estate, operate real estate, there's cost segregation studies that can be done on real estate. Basically, that allows you to break that real estate up into different pieces and get a write-off more quickly. So, as an example, I'm here in a commercial building. A commercial building's depreciated over 39 years. However, there are components of this building that are not going to last for 39 years. There's flooring and carpeting, there's electrical and fixtures and things like that inside this building that will last far less than 39 years. They'll be given a useful life of 5, 7, or 15 years. And the tax code with that bonus depreciation allows anything that's allocated to 5, 7, or 15 years to be fully written off in 1 year rather than over a 39-year period. So that can be helpful as well. All right. Then we talk about some core tax planning strategies. These are often what I would call like your TikTok tax strategies. You hear about them on TikTok or YouTube or things like that. Sometimes those are really good. Sometimes they're not as good, but we'll go through the good ones here and talk about ones that work and that we apply to clients. So first off, entity selection and optimization is very, very important. A lot of clients will go with an S corporation because that allows you to save money on employment taxes. Basically, if you're operating as a partnership or as a sole proprietor, all the money that you make is subject to both income tax as well as employment taxes. So if you are operating as a sole proprietor, you're filing a Schedule C on your tax return. Let's say your business nets $100,000 during the year. You will pay income tax on that $100,000 based on your income tax rate, but you will also pay employment taxes on that $100,000 at a 15.3% rate. So $100,000 of business income generates a bill of about $15,000 for employment taxes. Whereas if you are an S corporation, you can now limit the amount of employment taxes you pay by paying yourself a reasonable compensation. And a reasonable compensation is defined as what you would pay somebody to do your job. So let's say that what you do is you'd pay somebody $50,000 to do that job. So now you turn your business into an S corporation. The business still makes $100,000. You still pay income tax on the full $100,000, but you only pay employment taxes on your W-2 salary, which now is only $50,000. So employment taxes on that are $7,500. So just by becoming an S corporation and paying yourself a reasonable compensation, you've saved yourself $7,500 in taxes, and that is an annual savings. So if you run that business for say 10 years, that's $75,000 in tax savings over that 10 years. And it'll probably be much more than that because your business will likely grow during that time. You'll be making more than $100,000. So one of our clients, we had them as an S corporation, and they were doing $1 million in business per year. And so we will calculate their savings. It's usually around $50,000 a year that they save in employment taxes and other taxes by being an S corporation. There is a potential way to be categorized. Usually C corps we avoid because there's double tax on those. Is what happens is a C corp makes $100,000. It then pays tax to federal and state. So federal, it's a flat tax of 21%. So $100,000, 21% automatically goes to the IRS's tax. There's no itemized or standard deduction or graduated tax rates or anything like that. You make $1,000, you're paying 21% to the IRS, regardless of the amount of income you make. So $100,000 of income, 21,000 goes to the IRS immediately, leaving $79,000 for the owner. So you could then take out a salary for that and pay employment taxes on that full salary. You would need to take some kind of salary out of there. But anything that you take over and above your salary is considered a dividend, and you are taxed on that dividend that you take out. So that's where you run into double taxation. The C Corp gets taxed, and then you personally get taxed. The times that a C Corp are beneficial is if you plan on building that business up and selling it in 5+ years. You can get the QSBS, the Qualified Small Business Stock, and basically you can exclude the gain on the sale of that company. So that's one advantage of a C Corp, but it's very rare. Some other core tax planning strategies that we run into is the Augusta rule. It's called that because the Augusta is a golf championship that happens in Augusta, Georgia, the Masters Championship there. And somehow, somewhere along the way, people got on the tax laws that you can personally rent out your residence, your personal residence, for up to 14 days during the year, and you personally do not have to recognize any income on that. So when the Masters Championship comes to Augusta every year for a couple of weeks, people that own homes in that area can basically rent out their homes for a crazy amount of money and go and live in a hotel or take a vacation or get out of town or do something else. But they can rent out their homes for that entire 2 weeks, make an amazing amount of money during that time, and not have to pay, not declare that or have to pay any tax on that on their tax return. They might have to declare it, but they can back it out through a deductions. But basically, they don't have to pay any tax on that income. So in the business world, we use this to rent homes to the business. There's a lease agreement between the homeowner and the business where the home is rented to the business. The business uses that home for a day for a business purpose, such as meetings, planning, or other sorts of things. And the business gets a deduction for that rental, and the homeowner does not have to recognize it as income. So it's a way that the business gets a deduction and no offsetting income on the homeowner side. So it's a true tax savings in that sort of way. There's also accountable plans that work really well for businesses. This is where you'd have basically it's expenses that a business owner incurs personally, but are actual business expenses that the business would then reimburse. So things like your home office, your cell phone, if that's not run through the business, internet, mileage, and other travel that you pay for personally. So you set up an accountable plan, which basically allows the business to reimburse you for those things. Currently, there is what's called the SALT strategy. It's the pass-through entity tax. Most states allow this. And kind of the issue that we ran into, and it's kind of a fading issue a little bit, but the 2017 Tax Cuts and Jobs Act limited your itemized deduction for state and local taxes to $10,000. Certain states weren't very happy with that limitation, specifically New York and California, that are typically very high tax states and have a lot of people paying well over $10,000. They didn't like the fact that their citizens, their residents were being limited by this deduction. So they came up with a way that says, okay, what if we allow business owners to pay their state tax through their business, take a business deduction for that, and then we'll give them a credit on their state tax return for the taxes they pay through their business. And so the states had proposed that, and the IRS agreed and said that that was a valid deduction and way to save money on taxes. And so since the IRS acquiesced to that, most states adopted the pass-through entity tax regime and allow businesses to basically pay their state taxes through the business. Every state's different and operates very differently. Some of them will kind of shut that down. I live in Utah. Utah passed the pass-through entity tax and set it to expire at the end of 2025. So unless the legislature renews that next year, that opportunity will go away at the end of 2025. But yeah, we'll see what happens there. The reason why it was set to leave at the end of 2025 was because the 2017 Tax Cuts and Jobs Act was set to expire at the end of 2025. But the One Big Beautiful Bill extended a lot of the 2017 Tax Cuts and Jobs Act provisions. So my guess is that any states that set a phase out of that deduction for the end of 2025 will likely revisit that and allow that to continue going. Okay, so quickly on the operating side, there's other sorts of things. Paying children is always a really great tax benefit, especially if the children are under 18 years old. When they're under 18 years old, you can pay them up to the standard deduction, which as we head into 2026, that's about $16,000 per individual. So you can pay your children up to $16,000. They don't have to pay any income tax on it, and you get a full business deduction and write off for it. So it's kind of like the Augusta, where you get a deduction on the business side, but don't have to personally pick up any of those income taxes. So it's like a true tax savings that come through there. Um, and then when hiring children, you want to make sure that uh, you're keeping track of their time and you're paying them a reasonable salary, reasonable wage. You can't just blanketly pay them $16,000 and have no documentation or anything that goes along with that. You want to make sure that they're working reasonable time and things. All right. We'll keep moving along here. As you're operating businesses, there's often a lot of retirement plan strategies. There's SEP IRAs, simple IRAs, 401ks. Those are, a little more complex to go into at this point in time, but just know that there are a lot of retirement plans and a lot of ways to save money on retirement that way. And they're always want to consider Roth versus pre-tax and number of things there. That's where it's great to work with between a financial advisor and a CPA. That's how we work with clients. We usually get their financial advisor involved because there's so many financial advisory aspects that go along with retirement and that type of planning. So. All right, and finally, we'll move on along here to the exit. Exiting of a business can often come with a very large tax bill. Hopefully, right? Well, because hopefully you're exiting for like millions of dollars and making a bunch of money. And when you're making that millions of dollars, the IRS takes notice and comes in and wants their cut. So we look at some strategies and ways to help reduce taxes on the sell of it. We talked about the purchase price allocation in depth when we went through the buyer side. On the seller side, again, to kind of reiterate that, the seller really wants as much allocated to goodwill as possible because that's going to net them a long-term capital gain. The buyer, again, doesn't necessarily want as much going to goodwill because they have to amortize that over a 15-year period. So it's going to take them 15 years to cover that. But depending on CPA, usually when we're working with clients, I've worked with clients on both the buy side and the sell side. If you're working with a proactive person, we've been able to get good results for our clients on both sides because for some reason or another, the CPA or advisors on the other side were either lacking or just not as proactive as we were. And so we've always pushed for our clients to get the best results. So when clients sell, we've usually been able to get quite a bit allocated to goodwill. When they are buying, we've been able to get quite a bit allocated to fixed assets. So we've been able to help them that way. So yeah, you want to have good professionals helping you along that way. Um, you do want to be careful when you're selling a business because, again, like anything that's allocated to fixed assets could trigger depreciation recapture. And that's all taxed as ordinary income. So if you've bought a piece of equipment for $100,000, you've depreciated that down to zero. And now a purchase price allocation allocates, say, $50,000 to that piece of equipment. You will pay ordinary income on that $50,000 of gain on that one piece of equipment. And usually when you're exiting a business, it's you're in the top tax bracket. So you on the federal side, you'd pay 37% tax rather than say 15 or 20% that you'd get on a long-term capital gain. And if you are in a high tax state such as California or New York, ordinary income is often hits the 50% plus tax on rates because you've got 37% federal and then usually around 12 or 13% on the state side. So we're running into about 50%. So on that sell of that equipment, if you sold it for 50,000, have 50,000 a gain, that's $25,000 in tax that you would pay on the sell of that equipment. So half of that cash would go straight to the IRS and state.
What are some of the states that have the most favorable tax?
Yeah, there's several states that don't have any tax at all. So that would be like Nevada and Florida. Texas doesn't have an income tax, but they've got a franchise tax that can sometimes be nasty.
Mhm.
There's about 7 states that don't have an income tax. So if
Okay.
you live or operate a business in one of those states, that might be more beneficial. In that sort of way. Yeah, thanks for that question. Yeah, and like we mentioned, yeah, goodwill is the seller's best friend and very helpful that way. There also can be ways to minimize the tax through an installment sell. So rather than having the buyer go and get a loan or pay all cash for that, Maybe the business owner finances that and has the seller pay them over a period of time. Let's say that you're going to sell the business for $2 million. Well, $2 million would put you in, let's say it was all capital gain, that would put you in the 20% long-term capital gain bracket. So you're going to pay 20% of that 2 million in long-term capital gain. Versus if you structured that over, say, a 10-year, $200,000 over a 10-year period, there could be a 0% capital gain rate that applies to some of that, or at most it'd be like a 15%. And so that could be a way to save some tax that way as well. Of course, there's a bit of risk in doing that because you're now trusting that this person will pay you over a 10-year period. And if something happens in the business or they go out of business, then you might not get your full money that way. So things to keep in mind there. All right, and then moving on, some final tax strategies that we look at on an exit is sometimes we're looking at some advanced strategies where there's a way to accelerate deductions with financing. So in some ways, we're looking at like some turnkey businesses that can be started with minimal effort and minimal running time. So a lot of times we see like somebody being able to come in and put like $100,000 down. That buys them an asset that's worth $500,000. They get a $500,000 write-off in the year that they buy that. In our higher tax states, New York, California, they're saving $250,000 in tax in that instance. So $100,000 down, $250,000 of tax saved, nets them $150,000 in their pocket. They then have an asset that's typically being leased that they're getting lease payments from. Those lease payments are covering any note payments that they might have, plus providing some positive cash flows to them. So we've seen some good results with that. There's deferral mechanics, ways to defer gains. We've talked about installment sales, or maybe earnouts. Sometimes loss harvesting. Let's say that you sell a business and recognize a large capital gain in that year. If you have some investments or stocks or something that are in a loss position, you could harvest those losses to help offset some of that gain. So that's another option as well. And then there's a number of other things. You can, some credits. There's R&D credits. If you own buildings, there's an energy efficient commercial building. Looking at different types of entities, and then yeah, things like that. So yeah, and then just be careful on aggressive planning and things like that. IRS tends to look at things as substance over form. They want to see valuations of things for when you're depreciating assets. And then you want to make sure you have good proactive compliance, documenting things and taking care of them that way.
So
And
what moves the needle the most um, of all those things you just discussed for a founder exiting with a big exit?
yeah, the biggest thing to kind of look at. Um,
Yeah, just the biggest needle mover.
yeah,
Because some of those seemed really marginal. So I'm
uh,
just wondering.
yeah. Yeah,
Hmm.
I would say purchase price allocation is really important, especially if all of your assets are fully depreciated, because that's going to make a difference between, say, a 37% tax rate versus maybe a 20% tax rate. So that could be a 17% swing in taxes on that. That's generally what we look at really heavily is
Can you
something.
just briefly re-explain that one more time?
Yeah,
The
yeah,
purchase
absolutely. Yeah.
price allocation.
Yeah, so yeah, when a somebody sells a business, there's going to be a purchase price allocation that's done with that. So let's say you sell your business for $1 million to make it easy. And the purchase price allocation says, okay, great, you sold it for 1 million. 500,000 of that was fixed assets, and 500,000 of that was goodwill. Um, and then so, the fixed assets get a valuation at a 500,000, 500,000, but you probably bought those for, say, 1 million or 1.5 million or whatever the original purchase price was. And then
Right.
using the tax code, the bonus depreciation, 179, all that sort of stuff, you've depreciated those to zero. So you basically have zero basis in those assets. When you now sell those assets for $500,000, since you originally bought them for 1 million and took a depreciation on those, the tax code says you got an ordinary deduction on those assets. When you now sell them, it's considered ordinary income. And so your tax rate on that $500,000 is 37%, whereas your
Yeah.
tax rate on goodwill, in that scenario, if you're under the top tax bracket, it could be a 15% rate. So in that case, you could have what, like a 22% swing in tax rates and something like that. So, yeah.
So you're talking about depreciation recapture on all the equipment and assets that have been depreciated. And so what I'm understanding about purchase price allocation is it's trying to bucket as much into goodwill as you can because it's a lower bracket.
Right, exactly. Yeah.
And
Yeah,
that
bucket into goodwill, and then that's where installment sales can really come into play and do really well because the longer you can stretch out capital gains, the lower the rate is on them. Like in that scenario, let's say you
right.
sold your business for 1 million and you had a 10-year note on it, so you got $100,000 a year. Let's say you just didn't have any other income, you're just living off that 100,000 that comes in. Well, that puts you in basically a 15% tax bracket, and the capital gains rate in that bracket is zero. And so that would be a way to get $1 million over a 10-year period and pay zero tax. Now that's kind of an extreme example, but that's a way of taking goodwill and you don't and the other tricky part of that is, let's say you do an installment sell for 10 years and it's all allocated to equipment. There's a rule in the installment sales that says you can't do installment sell on depreciation recapture. So if you
Hmm.
sold your business for $1 million, it's all allocated to equipment, and you don't get that for 10 years. The tax code says, well, sorry, Charlie, your whole $1 million is taxable this year because it's all depreciation recapture. So that's a
Yeah.
really bad scenario where you're now paying tax on $1 million
Wow.
that you're not going to get for a 10-year period, right? So.
Right. That makes sense. So can you get any type of what was the term installment for with traditional financing as opposed to what you're talking about, more of a seller finance scenario?
Yeah, well, when you're the seller, it's all based on the money that comes to you. And there are some like really advanced strategies. There's things called like deferred sales trust and things like that a seller can look at. Those sometimes get challenged by the IRS, so you have to make sure you're working with a good attorney and getting those all set up appropriately and with
That's
the right.
what is that pretty much your trust is purchasing the company? Because that was my next question is can you figure out how to structure it so it's almost like a recapitalization and it's not a different entity, it's still you, but you're kind of recapping the company into another legal entity. Does that make sense or is that illegal because it's not arm's length?
Oh yeah, right. Yeah. The code does get tripped up on related party type things, and a lot of wouldn't apply. Yeah, you can't. Yeah, it'd be nice if you could kind of sell to yourself through a different entity, but yeah, the code. There's like what's called step transaction doctrine and substance over form, and yeah, there's a number of tax and legal terms that don't allow that, or tax and legal laws that don't allow that to happen, unfortunately.
I had a
So
question about goodwill.
yeah.
I know high level what goodwill is, but
Mhm.
maybe you could dig a little bit deeper into what that is and how the audience could benefit from being very strategic about creating a goodwill plus the installment option for the most strategic positioning.
Yeah. Goodwill is often called blue sky. It's
Yeah.
basically, and the way that it works, we kind of talked about there's different asset classes, 1 through 7. Basically, when you sell a company, you start with asset class number 1, which is like cash and things like that. And you work through all these asset classes. And so you say, okay, we bought a business, this much went to cash, this much went to receivables, this much went to inventory, this much went to fixed assets. There's all these categories that you kind of go through. And then when you're done going through all those categories, and let's say you sell for 1 million and you've gone through category 1 through 6, and you've allocated 600,000 of that purchase price allocation to categories one through 6. Whatever is left over, that 400,000 that's left over, that is what becomes goodwill. So it's basically when you purchase a business, after you've allocated that price to every other asset in there, whatever's left over is basically called goodwill or blue sky.
Okay. That's
Well, and
good.
if there is anything left over, that means the buyer is paying a premium above and beyond any real assets for pretty much the enterprise value of that company. Is that the correct way to think about it?
Right, exactly. Yeah. There's some kind of reason why a buyer is paying more for a company than the assets are worth. And that's when you get into like trade names or customer lists or just kind of general the goodwill of the business and company out there.
That's
So yeah.
good.
Yeah.
Well, we just want to say again, thank you so much, Meryl. I think you've done a wonderful job, and thank you for explaining this in very in-depth detail. Um, I'm gonna finish out for the day, and thank you others that are joining us both live and if you're watching this on a replay, and some of the people that have asked the questions as well to help us dig a little bit deeper into this topic. I'm gonna kick it right over to our screen here and then just finish out around the acquisition HQ network and then also what is to come. We've got a lot planned for next year, 2026. We're extremely excited about it. In January, we will be launching the acquisition headquarters Salt Lake City council. Each of the councils will have an educational session as well as deal flow opportunities for investors. And then secondly, we will have a mastermind session in essence where individuals will have a breakout in pods to help them define and discover their issues and solve those problems. We believe, though, that it's important to have a very private, curated room of individuals through a network. And that's why we have a web app that helps to connect everyone with the entire organization. We have curated introductions to individuals that are a part of the network. And then with your involvement, and I'll share with you guys the next options that you can have or that you do have in order to be a part of our network. You do receive a free entry into all of the AHQ council meetings across the nation. You can drop into in any of the states that we're going to be growing. And then also you receive a free VIP ticket to Acquisition Conference, which is our national conference coming up again on March 5th and 6th. This is just a quick little screenshot of our tech stack where we're having a growing library of options available for people to invest in deals. Then we have a learning chat as well as various M&A experts like Meryl here that can help you with obviously any aspect of the transaction. Moving on, pricing for the group is $3K per year. That provides you full access to all of our recordings and live sessions, just like what you heard today. In addition to that, you have full access and curated introductions through our community manager. You have free access to all the tour events as well as all of our AHQ council meetings and just a plethora of other opportunities. I won't go through the entire process, but there's a lot of value that we're putting into this network as well as into your value. If you're not a member, none of that is included other than just the educational live learning sessions just like this. Our national conference is called AquaCon, and again, it's coming soon. We're excited and we'd love to have you there just to meet, mix and mingle, have an experience, and as well learn from subject matter experts just like Meryl here. And Meryl is actually one of our they are the title sponsor actually for the National Conference of AquaCon in March. So we just want to thank you for that. If you guys have any questions or would like to apply to be a member of our network, simply just go to acquisitionhq.co/network. And then as well at the acquisitionhq.co, you will see the councils that are being launched, the conference, as well as all the other access points. So thank you again for sharing today, Meryl, and thank you guys for tuning in on this bi-weekly educational session. We will have a next one in 2 weeks, and that is going to be about creating a transferable business with an investment banker out of California. So again, thank you so much, and we can't wait to hear from you guys again.
Thanks, Meryl.